Welcome to the Gold Newsletter Podcast, your bank of knowledge of investments, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives to increase your wealth monetarily and educationally.
This is the Gold Newsletter Podcast. Fergus Hodgson here. So excited to be back for 2019. Thank you to all the listeners. The show keeps growing, and I really appreciate the support. And we are privileged to have one of my favorite economic writers, commentators, academics joining us today, Larry White, or Lawrence White, the man I met during my first maybe period of writing in economics at AIER in 2009. He, at that time, was moving from, if my memory is correct, Washington University in Missouri, and then to George Mason, where he still is now. He's an economics professor there. And he writes or blogs mainly with alt-m.org, which is a project of the Cato Institute. Alt-M is short for Ideas for an Alternative Monetary Future. Yeah, so with the Cato Institute, and he's the author of many books, too many for me to name here. His PhD from UCLA and BA from Harvard. Larry, welcome back to the Gold Newsletter Podcast.
Thanks, Fergus. It was the University of Missouri at St. Louis where I was before I came to George Mason in 2009.
Sorry, mate. Yeah, so the topic I pitched to Larry, I mean, you should read his work at Alt-M, and he just had one published at American Banker, which was on the future of digital currencies. But the topic we pitched was why Bitcoin has struggled and basically failed to become a widely used medium of exchange, which is what many of us hoped for, or maybe hope is too strong of a word. We expected, some of us expected that, maybe naively. Now, the reason why this is particularly important, and this is from an article Larry wrote in October about, after 10 years of Bitcoin, how does it stack up to its objective? And you compared this to what the objective was to whoever Satoshi was.
Yeah, so Satoshi wrote in addition to the white paper, some blog posts, some messages to message boards promoting the project and describing his or her or their hopes for it.
Yeah, so you point out three basic problems with the status quo, and that it's trust in a central bank, a lack of privacy, and then maybe high costs associated with payments. How has Bitcoin stacked up compared to those?
Well, so Bitcoin has provided greater privacy, not complete privacy. It's not anonymous. Transactions, actually a lot of information about the transaction is publicly available, and it's just a matter of connecting the dots or using big data to trace the transactions back to the real people, unless there's additional cloaking added, which is extrinsic to Bitcoin itself. It hasn't really provided an alternative to central banking in the sense that the money we all use is still central bank money.
Yes.
It's difficult to do much of your business using Bitcoin. And then Bitcoin itself as we found out in 2017 when it became more popular, ran into a big congestion problem, which made the cost of transacting in Bitcoin quite high. It's come back down since volume has come down, but for a while, Bitcoin conferences were no longer accepting Bitcoin because the payment fees were too high.
The irony is brilliant. So, I'll just add to that I, for years, did pay people who worked with me in Bitcoin, but in 2017, like everyone else, I just saw that the prices were the costs of transaction were basically making it not competitive with just conventional routes of transferring money, which is a little bit disappointing for those who really were behind the currency. So the basic challenge was that, congestion, it has not dislodged state currencies at this point, and the privacy, Bitcoin itself does not offer privacy, but there are techniques associated with it that one can use, and I assume other cryptocurrencies do offer more privacy. So why were these challenges not foreseen by the original creators, or did they foresee these challenges? Because presumably they must have thought of how many transactions the platform could handle before they put it out to the world in 2009.
I think they did understand the looming congestion problem, but back in 2010, people like Hal Finney
Yes.
and Nick Szabo, who were, if not Satoshi, we don't know, but at least in that circle, were saying that you're not going to be able to buy coffee on the blockchain. There will need to be a peripheral layer that settles on the blockchain for small transactions.
Why has that peripheral layer not evolved or developed?
Well, it's under development now, of course. The Lightning Network is the one that people are most excited about. So, I mean, that's a technological problem that may be technologically overcome. The problem that's more serious, that's more of an obstacle to day-to-day use, I think, is the volatility and the value of Bitcoin.
Sure.
And that's baked into the way the supply system is designed, such that, as an economist would say, the supply curve is vertical. The quantity doesn't respond to price, and therefore fluctuations in demand show up with full force as fluctuations in the price or the purchasing power.
Is that so correct, though? I mean, in the 100%, yeah, you're right. It's basically vertical or fixed. However, so many people hold Bitcoin as a speculative vehicle or just hold it for a wealth protection as opposed to for transactions. Couldn't they be induced to bring it onto the market and supply it? There must be some flexibility there. Do you follow my question?
Yes, but as demand goes up, purchasing power goes up. Some people may sell.
Right.
So I guess that would moderate the upward movement.
Because there still is a market for Bitcoin, right? A supply and demand. Some people hold it, and they can either hold on to it or bring it, trade it, and they're not all using it for transactions. But it isn't as flexible. I mean, the analogy you make is to gold, of course, where you actually can go out and mine more of it. And if the price of gold were to double, there'd be a heck of a lot more mining going on.
Yeah. So there's a supply flexibility in gold, and at least in the long run, over 20 or 30 years or however long it takes to dig deeper and bring out more gold. But in the case of Bitcoin, we already know how many units there are going to be at any future date. There's no flexibility in that sense. And there's no, you might say, natural price. There's no long run trend toward which we keep coming back the way there is with gold. And so if you're a speculator and you see the price going up, you would only sell if you thought, well, it's not going to stay up, it's going to go down. But you have no reason to think that. You're just as likely to hold on to it thinking it's going to keep going up.
Yeah, it's, in terms of getting the fundamentals, in terms of the fundamental value of Bitcoin, I don't know how one even gets started with that. We've done a show discussing that topic with a specialist in Argentina, and I still haven't really got my head around how anyone assesses the fundamentals, because the fundamental value is its use as a currency. Its use as a trading vehicle.
Right.
It has no conversion to anything else. So its value is basically determined by its popularity for use.
Correct.
And until it becomes very popular, it doesn't really have a lot of value. But there is speculative value, apparently. So yeah, we've got these three challenges that have not been overcome, and this is what one of my an expert friend has suggested to me, that we can get over the congestion problem through off the chain transactions. I don't know whether this would be considered fractional Bitcoin banking. Is that an accurate analogy?
It depends on the contractual arrangement between the user and the provider of the off-chain transactions. It can either be done on a fractional basis with some kind of reserve, or
Yes.
it can be done on a kind of warehouse basis. But I guess, or you can consider it a kind of credit transaction if it's, I'll credit you with the receipt of claims to Bitcoin, and we'll settle up at the end of the day. So what's being transferred is a claim. So in that sense, the claims could exceed the number of coins actually being used to execute the claims, but they'll be clearing before the final settlement takes place. So yeah, it is a way to make the supply of claims to Bitcoin flexible between settlement dates.
But I guess the implication there is that there is technology or there are strategies to overcome this congestion problem.
Yes.
And still many people cling to what is, I guess, known as the Bitcoin maximalist or maximalism. They stick to this position, and they would see, that it's maybe the gold standard of cryptocurrencies. I'm not as optimistic as those people about that, and see there is a problem there. But
let me say that some of the Bitcoin maximalists are also 100% reservers when it comes to their understanding of the gold standard.
yes,
And so one thing they like about Bitcoin is that it doesn't require or fractional reserves, or it can be operated without fractional reserves. And they see, even if fractional reserves are cheaper, they don't want to use them. So they see that as a virtue, that it's like 100% gold standard.
yeah, because if you deposit Bitcoin in I don't even know how you make these analogies, but when you actually, in the free banking or gold banking case, you would deposit physical metal and take out a claim, and yes, there would be more claims in existence there than there is physical metal, but I don't know how many claims to Bitcoin are out there, or whether they would even be necessary, since Bitcoin is digital and there's no problem of portability.
Well, if you're transacting peer-to-peer and not using Lightning or any other peripheral network, then it's like handing over a gold coin.
Right.
But it has all the slowness and, well, not all the slowness, not all the inconvenience of a gold standard, because you avoid the physical carrying around of gold.
Yes.
But it has some of the same problems of trying to operate 100% reserve gold standard. And I don't see any reason why, if people, for their own convenience and lower cost transactions, want to make agreements to use claims that are settled later, that they shouldn't be allowed to do that.
Right. I mean, that's a matter of what should or should not be permitted, and people are going to make fractional, or you're going to use claims rather than the underlying asset if it's more convenient.
When it's advantageous to do so, yeah.
Yeah. So, okay, and then the price volatility. I find this difficult to get my head around, because I have read a paper, I think this was in 2018, about the fact that the actual volatility in the Bitcoin price had been coming down. Has that reversed, or has the volatility actually been coming down in a consistent or long-term manner?
I believe there was a period in which it came down, but I think it's back to where it was before. I would have to check the numbers, but that's my impression. We haven't seen a permanent reduction in.
Even if there was a reduction, it has not been sufficient to quell the concerns of vendors, basically.
So it's much more volatile than the price of gold, something like 6 to 10 times as volatile.
And even gold, I mean, obviously this is the gold newsletter, so we watch the gold price all the time. And I mean, I guess people could say that it's really the dollar that is losing or gaining value, and not the value of gold itself. That's up for debate. But regardless, the price of gold in US dollars is going up and down every day, and by a considerable amount.
I mean, to make an apples-to-apples comparison, we should measure everything's volatility in terms of a price index, in terms of purchasing power.
Sure.
Not in terms of one currency.
Right. Well, so the value of gold, maybe in purchasing power, has remained much steadier than, say, the dollar, for example. Well, then say it's price in dollars, right? And if Bitcoin is just giving, you said 5 to 10 times more volatility, that is problematic. So I don't know if that hurdle can ever be overcome, because there's really no way to change the supply of Bitcoin, and people don't want to change. The whole idea was that it could not be changed. So
that's right.
Is that basically just a fatal long-term attribute?
Well, I think it's baked in. Yeah. So the way people are trying to overcome that obstacle is to develop cryptocurrencies with so-called stable coins, with stability features built in, with a different supply mechanism. And there's a problem there, which is now you have to trust somebody to make the adjustments.
Right.
There are coins that claim to have an algorithmic central bank function, meaning there's no human intervention in the adjustments that are made to stabilize the purchasing power. but they all require some kind of data feed into the emission program.
You're still relying on the precision of the data.
Well, and the honesty of the people feeding the data in.
Well, I want to push you on that question, though, as to how fatal this volatility is. No, not the volatility, the supply mechanism of Bitcoin, which many of us, I'll admit this as well, saw as a positive aspect that the supply was just fixed. We didn't foresee the challenges with price volatility.
Yeah. Well, it's certainly an asset, or it's a positive when it comes to assuring people that there won't be hyperinflation.
True.
And that nobody's manipulating the quantity to their own advantage. So it's impersonal and it's trustworthy, and it's like a really hardcore monetary rule that prevents manipulation of the supply. The problem is, it would be even better if you could have a supply that automatically adjusted to demand so as to diminish fluctuations in value and purchasing power. And nobody's figured out quite how to do that yet.
Sure. And with these stable coins, I mean, there are many on the market now. I don't know all of them. And I know you've been personally associated with this Initiative Q.
Right.
And so they're all. Is Initiative Q, is it an algorithmic one, or is it run by like a board or some people who actually manage it?
The plan is to have it run by a board. It's not a cryptocurrency. It's a Hayekian privately issued currency.
Yes.
Which will be deliberately managed to maintain the purchasing power. But it's at a very early stage, so still a lot of the details haven't been worked out yet, but that's the vision.
Right. So the stable coins, and you just say that with the algorithmic stable coins, which have no personal discretion or human discretion involved except for the data feed, why have they not, I mean, is it just too early to tell whether they will gain traction?
I think so. Very few of them have actually launched. A lot of them are still in planning. The so-called stable coins that are live, the biggest, of course, is Tether.
Yes.
Which isn't any more stable than the dollar. It's just a peg to the dollar.
Right.
So I sort of divide the stable coins into three classes, those that are pegged to a fiat currency. And it's hard to see that they have much attraction except as a way of doing dollar banking without having a bank account. So trying to go in and out of crypto markets with a bank account is very cumbersome. Yes. And, of course, subjects you to all the surveillance that bank accounts are subject to. So Tether is a way for people to park their, as I understand it, their proceeds from crypto transactions before selling one coin before buying another coin. But it doesn't provide any more stability than fiat currency does.
It seems like almost a defeatist strategy that we're just going to accept that the dollar is as good as it's going to get, or whatever other currency, rather than seeking to offer a superior option. Yeah,
I'm not sure it's even a strategy. It's just a transactions device. It's not an alternative currency. There's a little more hope, I think, in projects to provide a coin version of gold.
Okay.
So tokenized gold in the form of a crypto coin. And then the third category would be stabilization in terms of some price index, and I haven't sort of seen a live project doing that.
How does one... I mean, I've written about the prospect of these gold currencies. I just always find it challenging how you manage the cost of storage within the currency.
Well, so if we're talking about tokenized gold,
yes,
then yes, the gold is being stored. There is gold being stored in a vault,
right?
And especially if it's a warehousing or 100% reserve arrangement, somebody has to pay the storage fees.
Correct. And I just don't know if we're handing around a currency, does that currency just decrease in its purchasing capacity of gold each year, or is there some kind of fee built into it? How does one maintain it? Unless you go to a fractional system.
Right. If you go to a fractional system, then some of the assets can be interest-earning assets denominated in gold, and then that can be used to cover the storage cost. I mean, that's historically how banknotes and checking deposits became preferred to warehouse receipts.
Right.
You didn't have to pay fees, and you can even earn interest on your account balance. So to the extent that tokenized gold is 100% reserve or warehousing arrangement, it's going to face the same kind of fees. And as you say, they have to be assessed against the token holder. As far as I understand the designs now, it can't be an anonymous system. And it's not at all clear to me how it's going to be consistent with know your customer and anti-money laundering rules. So if the vaults have to identify who owns the claims to the gold, then you can't just transfer the claim to somebody else who's anonymous to the vault. They have to know who it is. And that makes it much less like an anonymous currency system.
Well, I want to get on to another topic a little bit, but I just want to read a quote from you from your article, which I thought is clear, right? So after we've discussed these challenges, and maybe they're fatal to Bitcoin.
Fatal is too strong, but limit the appeal, limit the broad appeal.
Quote, Bitcoin should not be regarded as the last word in private money, but should be appreciated as a remarkable technological breakthrough. Okay, so unquote. I mean, I just think that's the clear case that it has introduced new technology and it has opened the door to many alternatives, but it is not the last word. So even if Bitcoin is struggling or will not achieve the ambitions that many of us had for it, that doesn't mean that we should lament, right? That it has made forged ground. Now,
so other designs can be built on its shoulders, so to speak.
Yes. But one of the topics, which your latest article is about central bank. Well, the headline is Central Bank Digital Currency, and this one was just saying how central banks they're aware of what's going on in terms of alternative currencies or private money, and some of them are trying or considering having their own digital currencies, which is somewhat of a misnomer because they do have digital currencies. It's just the way they would structure it, and you could have an account directly with the central bank rather than with a private bank.
Right.
Should we expect more of this? Are banks? Are they just afraid of competition? Why are they really going for this?
If you read the speeches that Christine Lagarde and other people have been giving, other central bankers and IMF and Bank for International Settlement people have been giving, they seem to be concerned that central banks shouldn't be left behind in technological improvements. They want to be, up to date. And so if they see instantaneous digital payments kind of outstripping the legacy banking and central bank clearing system, they don't want to be left behind or preempted or lose their customers. That's right. I mean, some of the central banks have increasingly started to think about money not as a medium of exchange, but as a medium of law enforcement. That's a line I borrowed from Nick Szabo.
Oh, wow.
And so the central bank digital currency is a way to put all currency-like transactions within the financial panopticon to make them traceable for law enforcement authorities. And so it's a kind of Trojan horse where people are promised, faster transactions and currency-like transactions, but they're not currency-like in their privacy property.
I'm not sure how much privacy one gets at any private bank in the United States anyway these days.
Oh, no, that's right. No, it's know your customer is the rule. And know your customer means reveal the information on your customer to the authorities when they ask for it. No, it's quite sad. They don't need a search warrant. They don't need a court order, anything like that.
I shouldn't laugh about that. No, it's just the fact that some of us like privacy, but it just seems to have gone out the window in many cases. And I don't know how much privacy you would be giving up. I guess it would somewhat speed up the process if we all had accounts just straight with the Federal Reserve or the Bank of Canada. One of the interesting elements from your latest article, which I had not thought of, was that if we were to put our accounts directly with the central bank, that would reduce or eliminate the role that intermediaries have, or the traditional banks have, in assigning small loans, and would make loan allocation much more politicized.
When you have your checking account at the bank now, in a fractional reserve system, it's backed not with cash in the vault, but with their assets. So they're lending, most of their assets are loans, business loans. It has been the bread and butter of banking. They, have loan officers who assess the loan risk and who try to evaluate whether the business that's asking for a loan is a viable business. And that's a very important credit allocation function. But when your claim is on the central bank, then you're funding whatever assets the central bank owns. And what do central banks own? Well, the Fed owns treasury bonds and mortgage-backed securities. They don't make loans to small businesses. It wouldn't completely eliminate banks funding small business loans, but they would only do it with their time deposits and not with checking accounts if all the checking accounts are at the central bank.
Right. Well, this is such a moving scenario, right? Where obviously we live in a wonderful era when there's so much experimentation or innovation taking place. And of course, I said, follow this work, this scholarly analysis, or not, it's scholarly but accessible analysis of alternative banking, just alt-m.org, a project of the Cato Institute. And Larry, do you want to recommend any other website where we might follow your work?
Well, that's where I'm mostly commenting on current events and policies.
Right.
I have a page at the Cato Institute, and I have a page at my university that links to my more scholarly works and books and journal articles.
How about a plug for George Mason University, studying economics there? I'm recommending it to one of my colleagues.
It's a great place to study. We have a vibrant PhD program. Students are really enthusiastic about economics and about substantive issues, not just techniques. And so we have a lively seminar series, and I enjoy a lot working with the students and my colleagues who are very interesting. It's a great economics department.
Yeah, and they have lots of fellowships available. The Mercatus Center is there, the Institute for Humane Studies. So I encourage people to check that out. There's a great opportunity there. And one of my old friends, Nick Zayak, completed his master's in, I think it was in public policy there. So there's there's some variety if you like a more policy-oriented program. Otherwise, yeah, Larry, I look forward to following your work. I read all your articles. There'll be more to come. Thanks for sharing your time.
My pleasure. Good to talk to you.